Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Thursday afternoon, February 27th. As always, keep in mind there is a risk of loss when trading commodity futures and options. Well, I'm going to talk a lot on technical factors again today and some things that I'm following in this current market. But I guess to start with, before we get into those technicals, I thought I'd just pop up a chart of the distillate inventory. And as we look at this last several weeks here in the energy report, the total inventories have moved sideways. We continue at some real low levels for this time of year, but we maintained the last 3 or 4 weeks. And the reason we have maintained again is because refineries are still running at 88% capacity and running at some pretty big levels. So that has kept our diesel inventory from dropping further, but we do continue at some low levels. Also, we'll be watching the demand numbers here. We continue to see this cold air set across the country and reading more stories today on the East Coast of utilities that are shutting natural gas off to their interruptible customers and forcing those folks to use heating oil. So we'll want to keep an eye on that demand and also how that affects these inventory levels. Now we'll get into some more of the technical factors here, and I know this gets a little wonky here, and if anybody needs a little more explanation on what I'm looking at here when I talk about the technical factors, feel free to give me a call and I'll try to get into it in a little bit more detail. But it is worth noting, I guess, from a chart watcher standpoint, in a lot of these key levels and items I'm going to point out do have meaning to a lot of these traders that trade on these technical factors. But what I want to look at here is our low that we hit back on the 1st of February, and from there we did march 22 cents a gallon higher in that short period till we peaked out here just last week. And again, in our last commentary, we kind of pointed out that this market was looking overbought and was ripe for a little pullback, and that's exactly what happened. Since that time, we've pulled back a dime a gallon, and we came down to this key retracement level, the 50% retracement of that 22-cent run higher, and that has held to this point. And I think this is a key level and a good possibility we could bounce off of that when we come in Friday morning. If we're trading much lower again and it broke below that, the next target down will be the 61.8% retracement, which I would kind of expect to hold. But if we do fall through that, then we're going to go down further. But I'm looking at these retracement levels as probably good buying opportunities or a place to get in. On this chart, the purple line drawn in there is the 200-day moving average. And I'd expect that 200-day moving average to give us some pretty good support on this heating oil market, especially for the seasonality in place this time of year. We would expect that market to continue to trend higher, in that to trade below that 200-day moving average would be very unusual for this time of year. So I'm looking at that as some pretty good support. Interesting enough, the April heating oil contract today settled at $3.77, which would put us right down here. The March contract comes off the board tomorrow on Friday afternoon at the close, and then April becomes a front month. And currently April is trading a full dime below where the March contract is. So if it does go off the board as everything is lined up here today, we'd be in this range, and then we would leave another gap in the chart here. Again, if we focus on those gaps like we did last month, we'd like to fill those gaps, and that's exactly what took place last month. We opened much lower than the February futures when it came off, and then we just marched higher through the month trying to fill that gap. We did not completely fill it. We came within a penny to a penny and a half of doing that and retreated from that point. But in any case, I think this is an interesting setup here as the March contract does expire on Friday afternoon. With that, I do have a recommendation that I like. It's the same trade that we put in place last month that worked for many of you, and that was to buy a call option. We would buy a call option on the April futures and start a couple cents above the current market. Again, today's close was just under 301. If we started at like 304 on a strike price, it would cost us 4 to 4.5 cents to get into that. And I think that's a pretty good place to put a hedge, looking for that market to move back higher to fill that gap. If we're wrong and it does go lower, we'll be out that 4 to 4.5 cent premium, but that's the maximum exposure we have on that trade. Um, and then we would just continue to buy the rack gallons at lower prices. But if it goes higher, then we've got a position in place to participate in those higher prices. But for 4 to 4.5 cents, I think that is a pretty good trade and something that you can absorb into your current margins. The forward curve, again, just pointing out the front month here in March, which is going to go off the board tomorrow. And then as we roll over to April, we're leaving almost a full dime of backwardation in that market. So would look for that gap somewhere along the line here to get filled in. So that's all I have today. Just wanted to point that out as we are getting ready for the March expiration tomorrow. Some things that we're looking at we want to be aware of, and a couple technical factors that came into play here today with the moving average and some retracements that I wanted to share with you. So if you would like to go in more detail or look at the option strategy that I had mentioned, buying that call option, there isn't anything we can do yet this afternoon. We have to wait till the market opens on Friday to place those trades. But give me a call and we can take a look at getting some things put in place for you. Thank you.